Hi, all. Very welcome to our first AI innovation in asset management roundtable. Many thanks for all of you who have registered. Many thanks for all who are dialing in now. We're very happy to have gathered a fantastic group of experts to talk about this topic. Many thanks here also to Wilmot Magazine for co-sponsoring the event. Many thanks, Paul. Many thanks, Dan. And with this, I want to introduce our moderator, Professor Rama Kant from Oxford University, one of the premier financial mathematicians who will chair the event. Rama, great pleasure to have you here. With this, I hand over to you.
Yes, thank you very much, Balash. I'm very honored to chair this roundtable. So the topic of the roundtable is artificial intelligence in asset management and how artificial intelligence has contributed to innovation in this area. So we will have four panelists. I will introduce them as we go on. We have Daniel Block from Blue Analytics. We have Dr. Mikel Nogueri Alonso. Then we have Peter Kolm, and at the end we have Igor Halperin. So each of them, I will ask them to give a presentation limited to 10 minutes, so we can have a short Q&A going to 15 minutes, and then after the four short presentations, we will have time for Q&A and discussion between the panelists, and we can also take questions from the audience. So with that, I'll just introduce our first speaker. So our first speaker is Dr. Daniel Block. So Daniel is head of quantitative strategies at Blue Analytics. I've known Daniel for a long time. I think since we were both young researchers doing our PhDs respectively. So Daniel did his PhD in the area of mathematical finance, and he has worked in the finance sector ever since as a quant in the various asset classes. And he has published many papers on mathematical finance, and he has turned his attention, like many of us, in the last few years to applications of machine learning and AI in financial modeling. And so he's going to talk today about some applications of AI techniques to dynamic risk management. Over to you, Daniel.
Thank you, Rama. Nice seeing you, and thanks for the introduction. So I hope everyone can hear me. Okay, so I'm going to start by giving a very high-level presentations on Blue Analytics, and then I will introduce dynamic risk management and give an example. So let's start. Okay. So at Blue Analytics, technology is at the core of our business. We focus on two main activities: systematic event trading and dynamic risk management. In terms, so in the unexpected news produce large returns, and our goal is to anticipate the large market moves and generate trading signals. To do so, we use first NLP to extract informations. We scrap market news live. We pre-process data. We classify and prioritize the news by importance. Once we have done that, we need to use machine learning to analyze the events. So we infer insight from the relevant news. We identify the best stocks to trade, and then we generate the trading signals. Having done that is not the end of the story, because we need to trade the signals and risk manage the positions in the portfolio. Our objectives are to dynamically maximize the risk returns. And to do that, we use reinforcement learning to analyze the market. The first thing we do is we use the option pricing theory, and I'll come back on that, to infer the true returns behavior. We compute those option prices by using reinforcement learning. And then once we have this, we can predict the future returns distributions, and we can predict stock patterns. Having those two informations, those two predictions, then we can devise quantitative strategies. And at last, we use reinforcement learnings to dynamically allocate our portfolio. I move on to the next slides. So now I'm going to discuss more in depth the dynamic tradings and dynamic risk management. So returns are decomposed into trends, volatility, and jumps. There are three components, which could be models with multi-factor stochastic processes. However, whatever model we pick to model each of those components, we will never get exactly the true market returns. The thing is that the future returns are unknown. So our solution is to use option pricing theory. And what I mean by that is we don't use options for trading purposes, but we use options in the historical measures to infer information about the future distributions of the returns. So based on different payoffs, we can infer different properties and different parts of the distribution of the return distributions. Having done this, we can also use those options to devise and define strategies. So we use those options to identify the trades opportunities. If we think that there is going to be a big returns on the market, then we want to enter the trades, or otherwise we don't. We need to identify the long and short positions, and we can also use the options to identify the entry and exit points. Now, in order to price those options on the market, there is no market model. So we must rely on deep reinforcement learnings to pricing those options. The inputs in the networks are mainly, in terms of variables, the stock price history and news event signals, combined with specific characteristic of the options that we want to price. So if it could be a strike, it could be a barriers, or it could be other features, depending on the payoff that we are pricing. Doing that allows us to generate strongly positively biased P&L distributions with very low downside risk and very high Sortino ratio. So I'm now going to give an examples of how that works. So here it's a very simple examples, and obviously you can complexify the product. The the examples with more sophisticated options and more sophisticated metrics. Here I'm just assuming that I'm going to be taking a long position, so the market is going up, and you can think of it as the Google car. You're moving along a trajectory, along a path, and at any given point in time and in space, you can look at the environment surrounding you, and you can use options to infer the future distributions of returns. So I can't really point on the graph, but you see an example of a trajectory with the distributions. So let's assume that where the trajectory is, we're at the stock S, and there is a few metrics that we need to infer to characterize the distributions. So we'll start with the risk target, which is denoted S minus, which is at the bottoms of the distributions. We have the reward target, S plus, at the top of the distributions. Then we can define the expected rewards, which is the difference between S plus and S. And we have the expected loss, which is the difference between S minus S minus. We have the distance, which is the range of the distribution, so from S plus to S minus S minus. And from that, we're going to infer two important metrics to devise our quantitative strategies. The first one is the global stop loss, which is the red lines at the bottom of the distributions. So here we define it simply as being the value of the stock where we are minus fractions of delta minus, which is the expected loss. And we are going to define the profit taking, which is the green lines on the distributions, and it's defined as the stock plus fractions of delta plus, which is the expected rewards. Now, this is well known in risk management. However, Usually people are using statistical models or forecasting models to infer the value of S plus, S minus, and D delta plus and delta minus. And instead of that, we're using options, as I mentioned before, to get the feel of the or estimate that distributions in the futures. So here's a very simple examples. We can combine calls and puts to define the market price of risk, so the MPR here, and that gives us information on the drift and the strengths of the drift. So if we want to enter or not the market, then the risk target S minus is given by the stock minus a put. The reward target which is S plus, is given by the call plus a stock, and the distance in that simple case simply becomes the call plus the put. As I said, you can combine or weights combinations of options and do that differently and get something which is more refined. But here it's just simple explanations of what you can do. So that translates, here is an example of dynamic stop loss and profit taking. So we have one trajectory in blue, which is the stop price. You are at the start of the day, we trade intraday, and we can enter and exit the positions as many times as we want based on this distribution. So at inceptions, we have the spot value, and then we compute or estimate the distributions using options, and then we can identifies the green lines and the red lines, so the profit taking and the global stop loss in red, and we let times evolve. So we move along the trajectory. If we hit the global stop loss, we exit. Then, based on some conditions, which I'm not detailing here, we can re-enter the position. So if you see a bit further down the lines, there is a new blue dot. So we re-enter the positions. At that point, we recompute the distributions of the future returns. So we get a new profit-taking lines in greens and a new global stop loss in red. The stock evolves as long as it stays within the bands, then everything is fine. Here in this example, the stop starts increasing and crossing the green line, so the profit-taking line. So what that means is that at that point, we recompute the distribution. So we have a new green lines, which is above the previous one, and a new red lines, which goes above. And here we have a trend. So we keep crossing the profit-taking lines, and the stock price, we go up, recompute the distributions, and modifies dynamically the structure of the green and red lines. If the stock was going to go down and cross the green lines, we'll simply exit and just take profit. And if the stock is crossing the red line, so the global stop loss, we also exit and wait based on some conditions to re-enter the trade. So here it goes up, carries on, then there is a kind of a plateau. We keep recomputing the distributions, and eventually at some point we exit because we hit the stop loss, but then based on some conditions we re-enters. And you can see that we keep trading the stock price using this dynamic informations on the profit-taking lines and the global stop loss. So we can test this in a backtesting engine. So we have developed powerful backtesting engines where we can vary the parameters that defines the quantitative strategies. We can vary the parameters that defines the process for the returns or the stock price, and we can vary different informations on tradings if we want to look at events every 10 minutes, 5 minutes, 1 minute, 1 second. We can do that. So in these simple examples which I'm presenting now, I'm varying the option maturities. I have 3 maturities: 1 day, 5 days, 10 days. In terms of how we define the green lines and the red lines and the entry levels, again, we have range. They're not written here, but we have a range of global distance level and global and local ones. So that's for the green and the red lines and entry levels. Then in terms of market setting, in here we are using GBM, and we are for the market price of risk, we're using an OU process, but you can combine anything you want. You can add jumps, you can have stochastic volatilities, and anything you want. In terms of simulation parameters, we are looking at bars of 15 minutes. We have 10 days, and we're simulating 1,000 simulations per combinations of parameters. I just need to hurry. One last slide. Here is the result. We have a distributions of Sharpe ratio and a distributions of Sortino. Both of them are positive. Both of them range between around 2 and 12. This is obviously everything is annualized, and on average on the distributions we have a Sharpe of 565 and a Sortino of 576. These distributions means that we have combined different types of market scenarios, some which are very risky, some which are less risky, some which are advantageous for trading purposes, or some which are very difficult. And in all scenarios, we're generating positive Sharpe and Sortino distribution values with an average which is quite high for entering and exiting intraday the stock prices. This is it for me. Thank you very much. Rama, it's all yours now.
Thank you very much, Daniel. So we have now our second presentation by Miquel Nogueri Alonso. So Miquel is the founder of the Artificial Intelligence Finance Institute, based in New York, I believe, or maybe it's based online, I don't know. Yeah. And he's also head of development at Global AI and co-editor of the Journal of Machine Learning and Finance. He also teaches at NYU Courant Institute of Mathematical Sciences and NYU Tandem and the CQF Wilmot Institute, which is hosting this event, co-hosting this event. And he has been taking a lot of initiatives, in particular education related to fintech, big data, and AI in finance, among other things, at the London Business School and NYU. So Miquel is going to talk about sentiment analysis, and more precisely financial embedding analysis of sentiment, a big topic that I'm sure many of us have encountered in applications of finance.
Yeah, thanks, Rama. Thanks the organizers to invite me. I'm going to be talking today about these 15 minutes about some work that we did along some collaborators, Peter Colm, who's also a panelist, and Jordi Armengol and Asier. So we work on a very interesting problem. So the idea is sentiment. So sentiment has been and is being used in finance. I think the first paper ever written was from Paul Tetlock in 2007, or at least the one that I know. And he started some sort of developing a sentiment for financial, some sort of science. So sentiment, I'll speak a little bit about traditional sentiment, but obviously I would just like to introduce, we're going to use one of these large language models. We're going to use BERT, right, or for the sentiment analysis exercise. But you know, basically the large language models like BERT or GPT-3 are two things, right? Or had to deal with two things, right? One thing was to solve the cause of dimensionality of the words, right? Or how do we represent the words? And that was started in 2013 with Word2Vec, right? And now and Globi, and now you can all do your own word embeddings. And second, how can you model these sentences, so the sequences of words? And first, the first thing started was recurrent neural networks, LSTMs, and so on. In 2017, right? Attention is all that you need. One really impressive paper from Bashbani and collaborators started, the area of transformer models, right? So BERT, that was from 2018, October 2018. It's a very large model. Then it came to GPT-2 and GPT-3 and so on. So we need, so here, these transformer models are basically based on attention and some encoders and decoders technology. We're not going to talk about this, but you can find it in the paper. But we used a derivation of the BERT, which is the bidirectional encoder representation from transformers. So using the transformers technology, using large amounts of data. So can we do several language tasks? And we will show that you can do that also with sentiment. A little bit of historical reference on sentiment. So first, traditional sentiment, or initiated by Tetlock and some others, right? It's about counting the frequency of words, and this is still really useful. So you count the number of positive words, the number of negative words. You can put together ratios. This is obviously not a lot of AI technology, but you can still do a lot of things with it. And second, can we use deep learning models, right, to do sentiment analysis? The answer is going to be obviously yes. Okay, so what's the advantage of going from these some sort of frequency methods to deep learning? So if we look at Financial Phrase Bank, which is one open source data set for finance, so the accuracy, if we use lexicon or frequency methods at 61, and if you go to multiple dimensions, so word embeddings and multiple layers, so recurrent neural networks or long-short memory networks or transformers, accuracies are much higher. Right. I'll also obviously be talking about the challenges, right? That are obviously many challenges. So we have when we do large language models. So we wrote last year this financial embedding analysis of sentiment, FINEAS, along with Peter Kolm, Asier Gutierrez, and Jordi Armengol. The main idea was we have sentiment. Sentiment is a number. We have an article, and we want to do a regression and say this is a +1 or -1, right? And obviously, there's a lot of challenges, right? I would like also to mention one fact is that there's no such thing as true sentiment, in the sense that it's not a measurement that we can do on the text, right? It's pretty subjective. So the challenge is it's very contextual. It depends on the reference. It can be imbalanced. So, for example, there can be companies or persons that have in itself sentiment, very negative sentiment, very, very positive sentiment. This is also an interesting thing to debate, but we have a short time. There's also irony. It's time dependent and so on. So it has a bunch of different problems, which makes our proposal was to use a Ravenpack dataset. So Ravenpack gave us access to a very large dataset of articles and sentiment that was previously labeled, right? So, and this is an important distinction that I want to make. The fact that we use deep learning, we're going to use a BERT model, but this sentiment, obviously, it's something that algorithms learn after reading these millions of articles and minimizing the mean square error, right? Because this is a regression, right? We have an article and we have a number that characterizes the sentiment of the article, right? And obviously this is a labeled data set. Sometimes or many times you just don't have that labeled sentiment data set, and then you need to resort to other NLP technologies, right? So that has to be clear. So thanks again, Ravenpack, for the data set. So the main idea was, and you can read that on our paper that was recently published on the Journal of Financial Data Science. So the idea was, or the main innovation was to use sentence BERT. Okay, so there was a previous famous paper, FinBERT, by a young researcher that it's I don't remember now the name. Sorry about that. But the main innovation here was, can we use instead of word embeddings, sentence embeddings, right? So nothing. This idea of embedding or representing words and then using neural networks, right? typically transformers in the case of BERT. So here we took a different approach, and we embedded the sentences, right, instead of the words, and then transformers and so on, right? So you can find the details of sentence BERT in the paper, and obviously the sentence BERT was previously developed, and you'll have there the good references. So what were the results? So we did the first iteration in which we freeze sentence BERT. We used it and then we use it as a feature. Then we use 2 layers of MLPs, and we produce a prediction. The results here were positive, or right, some sort of really impressive compared to BERT and bilinear LSTMs, right? You can see that these are the mean square errors, right? So these are right much lower. So here some sort of we're satisfied with the first iteration. The second, we unfroze the model, and we compared the model with FinBERT again, which is the competing some sort of right model, and our model looks better. And the 6 months on the 1 year are pretty much the same. In 2 years, right, it shows some sort of better results. Okay, so but what are the conclusions, right? Obviously, again, this is a very rich paper and the model, but we have to say some things, right? RMS is really low, so the model, after reading years of data, right, or 2 years of data, is doing a very good job, right? Does that mean that the model is going to be able to some sort of adapt to new situations? And obviously the answer is no, right? Or in principle it might not be right. For example, the first day that any model of any NLP model reads about COVID, the model still doesn't understand what's the word COVID, doesn't understand what could be the impact, and then it basically uses other words in the sentence, like the verbs and the companies that are in this sentence to produce the sentiment, and that might lead to inaccurate or just plain wrong sentiment. So that's why it's very important what we say here: the more historical data, the better, right? So there's a misconception out there saying, oh, these models are very large. Our take on this is that these models need to be very large, because these models actually, right, the transformers, the model needs to be aware of many situations, right? And for example, it needs to understand what's probability of default, right? It needs to understand what's a CDO. It needs to understand a lot of financial lingo. If you read and train the model in just a few years of data, he's not the model is not going to be able to actually maybe understand all these concepts, right? So I think here the definitions of data set and the data set needed have to be changed, right? This again, any NLP model, I think, needs to read a lot of data, very curated, and then they also need some sort of human betting, in the sense that you need to be able to say, right, will my model be able to do a good job in that particular context, right? Think a little bit like if you're working with a multi-factor model, right? And there's a new factor emerges, I don't know, for example, inflation, that was dormant, right? Or there was not impacting returns. All of a sudden, you have to figure out how you adapt, right, your multi-factor model, right, to this. So here's the same, right? The model needs to be bettered in the sense that new factors might emerge. These new factors, it's not guaranteed that the model is going to figure out at the beginning, on one shot or two shots, the correct answer. Maybe you need a little help, right? Okay. So how can you some sort of help the model. Right here we have, I have just a couple of slides talking about how can we some sort of acknowledge, so we actually can add an entity embeddings. So if there's a new thing coming out, right, we can tell the model, we can artificially, so to speak, give more data, and so on and so forth. And then we also need to basically look out for unseen facts, rare facts, more sensitivity, and so on and so forth. So the conclusions are these models are incredibly useful because they allow you to read large quantities of text, right? The accuracy, if nothing changes in the context, is really impressive, right? But as I said, you have to be vigilant to new factors. You have to be vigilant to some sort of sentences that are changing, right? So they require a lot of fine tuning or constant fine tuning. Thanks.
Yeah, thank you very much, Mikhail, for this presentation. We'll come back to it in the discussion. So our third speaker is Dr. Peter Koll from New York University's Courant Institute of Mathematics. So Peter, whom I've known for many years now, is the director of the Mathematics and Finance program at Courant and clinical professor of mathematics. So I guess that's the doctor in his title justifies the clinical. So if you have problems, he can fix it. He's also a frequent speaker, panelist at various academic and industry events, and he's been producing a lot of interesting work over the last decade related to machine learning in finance, AI techniques and asset management, high frequency modeling, low frequency modeling, so various aspects of AI. So I guess it's a very good choice for this panel. He was also awarded Quant of the Year by the Journal of Portfolio Management. We'll see another Quant of the Year in a few minutes in another category. But over to you, Peter, for your presentation on the detection of regime change with jump models.
Thank you very much for that introduction, Rama, and thanks to the organizers, Blue Analytics, for this opportunity to speak here today. So this is joint work together with Peter Nystrup and Eric Lindström at Lund University, and I will be talking about several papers that we have in this area with a focus on regime detection using this new class of models that we refer to as statistical jump models. So by way of motivating this talk, we're all familiar with this picture. Here we see in blue the cumulative return of the S&P 500 over the last 10 years. And in orange below, we see the annualized realized volatility of that same index. And a key question I might ask as a practitioner is, what are the regimes of the S&P 500? Or another way of saying it, are there good and bad times? Are there good times where I'd like to keep the risk up, so risk on? Or are there bad times where I'd like to step away from the gas pedal and go risk off? This is a well-studied problem, and over the years, probably the most common approach to this has been to lever so-called hidden Markov models, HMMs for short. These types of models come with their own challenges. One is that of that they're very sensitive to the model misspecification, or another way of saying that is that they depend very heavily on the assumption of the conditional distributions in each one of the states. They rely heavily also on the Markov assumption, and as a result, they tend to be sensitive to changes in the data, and they tend to be sensitive to the initialization, where I start the fitting of my model. And as a result, when I use these models to detect risk on and risk off periods, these hidden states often lack temporal persistence, and I might end up flip-flopping in between these states, which is highly undesirable from a practical point of view. And if that's not enough, they also tend to be computationally pretty expensive. And a big part of that is that while they converge, they are guaranteed to converge to a local optima. The convergence tend to be slow. So here are two of our articles on statistical jump models, and I will be predominantly talking about topics related to the top one here, greedy online classification of persistent market states using realized intraday volatility features. We have a follow-up paper that's called feature selection in jump models, where we go into asking the question of how I can generate a large number of features, but then select the features that are most important for the application that I have in mind. So here's the basic idea of a statistical jump model. Consider a model where we have two different states. On the left-hand side, state 1, the right-hand side, state 2. And one of the ways I can ensure that there's temporal persistence, or another way of saying this is to prevent a person from jumping back and forth between these two rocks, is to increase the cost of jumping. We can formalize this leveraging a large class of models that was introduced by Bemprod and his co-authors in 2018. They call these models jump models, but we have found that in the finance community, we're better served if we call them statistical jump models to distinguish them from jump diffusion models. These models have nothing to do with jump diffusion models. So what's the setup here? Well, so we have a time series of features that I'm denoting here by Z. We sample them over a time period, capital T. And then what we do is we fit model parameters, theta, and state sequences S here to minimize this objective that you see in front of yourself. Now, to better understand what we're looking at, consider a situation where lambda is equal to 0. And I think the majority of you will immediately see that this loss function is that of a k-means clustering problem, where the number of clusters are determined by the parameter capital K. So by introducing now a non-zero, positive non-zero lambda, I'm ending up penalizing each time I'm switching states. So the intuition here is I perform a form of k-means clustering that has temporal dependence. Each time I switch states, I pay a fixed cost of lambda. And this jump parameter, as we call it, the lambda, we can think about this as a regularization parameter. As I dial up the lambda, the likelihood of me jumping between the states decreases. Now, here's an example of how we might generate features for a model of this kind. Consider a univariate time series. Why? This could be the returns of the S&P 500 index, for example. And I used that original time series, making various kinds of statistical transformations backward looking in time to generate partial moments of this time series. Here you see an example of, besides the observations themselves, an additional 8 number of features. And I stack these together in a large feature vector, Z, which I then use for fitting my model. Of course, when you have a lot of candidates for these features, feature selection becomes an important question to consider. How are these models fit? Well, they're fit using a coordinate descent type of algorithm that actually has a very similar structure to that of the classical EM algorithm that's used to fit HMMs. So if we start with a multivariate time series of our features, Z here, we initialize all of our parameters, and we initialize a state sequence. And then we're going to be iterating under point 1 here. We're going to iterate between doing either A or B. And in A, we're keeping the state sequence fixed, and we solve for the model parameters. In the case of the k-means objective, we can solve for that in closed form to get the parameters theta. And then we go to B, and we keep the model parameters theta fixed, and we solve for the best state sequence S using dynamic programming. And then we alternate between the two until our state sequence has converged. Once it has converged, we go to step 3, where we can now compute all the statistics that we might want about our model, compute transition probabilities, and other distributional parameters for each one of these states. So that's how we fit these types of models. Now, how does jump estimation compare to that of a classical EM algorithm for an HMM? Well, each iteration have the same complexity. These algorithms scale like order t times k squared, right? Where t are the number of observations and k is the size of the number of features. However, somewhat remarkably, and when we first started working on these models, this surprised us quite a bit, was that the jump estimation converges several orders of magnitude faster than that of classical EMM. So in the examples that you'll see here, we get convergence in about 5 iterations, whereas in an HMM type of setup, the EM algorithm would require somewhere in the order of 50 to 100 iterations. We're working with loss functions instead of conditional distributions. That's another advantage, allowing us to engineer the loss functions to our specific application if we'd like to. And these models tend to be significantly more robust to the initialization, and also much more robust in terms of identifying larger state spaces. So you probably wonder, what are the hidden states of the S&P 500? Well, I can announce today that nobody really knows, right? Because these are statistical concepts, but we can ask what these states might be through the lens of a statistical model. And here you see the cumulative returns again in blue and the realized volatilities in orange. And I want to draw your attention to the purple sequence at the very bottom. There you see the identified states by a hidden Markov model. And you notice that this model identifies that the majority of times the model stays in state 1, which is the good state, and at other times if it changes over to state 2, which is the risk-off state. But if one zooms in a little closely and looks at this, then you also realize that there is this flip-flopping back and forth between the states, which is highly undesirable in many practical applications. In the green and red, you see 2 different versions of the jump model at work here. And the jump model here uses the features that I previously shown as an example. And as you can see, the state sequences are much more persistent and much more robust in this setting. Now, there are a number of extensions that we have worked on here that I will not have time to go into during this short talk. We have introduced a technique for feature selection that we refer to as sparse jump models. That paper is available online, and with that paper we also provide the full code for estimating both jump models and statistical jump models. So if you'd like to test these models for yourself, have a go at it. We're currently working on performing model selection in these types of models. There's a number of parameters, hyperparameters, that need to be chosen in order to own in on the right kind of model. And we're leveraging generalized information criteria in an upcoming paper here with Federico Cortese and Eric Lindstrom. There are a number of financial applications that we have applied this to. And the first application has come to use in settings of creating hedging overlays for large lazy portfolios that have large equity exposure. You might want to dial down your exposure to equity during bad periods. So these models have a good use in those kinds of settings. And we're also working on applications related to strategic asset allocation and portfolio construction. So to conclude, a statistical jump model learns a hidden state sequence and the model parameters simultaneously in the style of an HMM. However, it's significantly more robust than the classical HMM. It gives me a way to control the rate of these jumps. It has fast convergence and tends to be less sensitive to changes in data and also to my initialization, and can be extended in a number of ways just to suit the application at hand. So thank you very much for that.
Thank you very much, Peter, for this presentation. Just one question before we move ahead, because we have a few minutes. So you, this jump detection, are you talking about this in terms of forecasting, or is it analysis of a time series? You say here was the break. I mean, past.
Yeah, great question. And the answer is you can use it for both. So you can use it for forecasting, or you can also use it after the fact to detect structural breaks. What I did not talk about here, there is also an online version of this model that allows you to do fast updating, so you don't have to do solve the full problem and do the full dynamic programming for online type of applications.
Okay, but the applications you alluded to at the end were like, we detect the break and then we react quickly before, things get too bad.
Exactly.
Thank you. So we'll come back to this obviously in the discussion, but now let's move to our last presentation by Dr. Igor Halperin. Igor is at Fidelity Asset Management. He is also Quant of the Year, but this time nominated by Risk Magazine. He has worked at various financial institutions. I met him when he was at JP Morgan, and he has been at Fidelity Investments for several years now, where he's the data science group leader. And he has done a lot of interesting work in the recent years on especially reinforcement learning, and now inverse reinforcement learning. And he will tell us all about this and how it applies to asset allocation. Thanks, Igor.
Thank you very much, Rama. Thank you for the great introduction, and thank you, Balázs and Daniel, for inviting me. So I'm going to talk about one of my favorite topics, which is reinforcement learning, and how it can be applied for asset allocation. So let me first start with the general intro into reinforcement learning. So what is reinforcement learning? Is a part of the machine learning, which deals with sequential or multi-step decision making by agents. So in this diagram, you see an agent, which can be anything. For finance, it can be a portfolio manager, trader, which interacts with the environment, which is on the right. And interaction can be either in real time, or it can be actually logged interaction. So if we deal with the latter case, then we talk about offline reinforcement learning. And this will be my setting. So you have just historical data set of sequences of states. which the agent receives from the environment, and actions that it exercises on the environment. And the goal of the of reinforcement learning is to maximize the cumulative reward by the agent. So reward is the measure of, if you wish, the measure of happiness of the agent from taking actions. And in general, it's a function of both the states of the environment and actions taken in these states. Now, and also there is another very important thing in reinforcement learning, which makes it really different from supervised learning and unsupervised learning, which is the presence of this feedback loop shown in this diagram in pink. Now, if you deal with offline reinforcement learning, then your data consists of tuples made of state sequences of states, actions taken, reward received. And then the objective of offline reinforcement learning would be to find optimal policy using this historical data. But there is one very interesting twist to this. Sorry, I jumped. Which is called inverse reinforcement learning. So imagine that we have the same situation, meaning that we have the historical data set collected from one agent or maybe many agents. So this diagram shows an example in the setting of quantitative finance. So instead of the agent, we have a trader. Instead of the environment, we have the market. And states and information about the states can in general contain both public information such as prices and returns of different assets, and also private information, which is the information about the state of traders' portfolio. So this is part of historical data set. It also contains history of trades made by this trader, but what it doesn't have in this inverse reinforcement learning formulation is the information about reward. So basically, you observe some behavior and you want to rationalize this behavior. That's the objective, and obviously it's very, very general objective. Inverse reinforcement learning tasks of inverse reinforcement learning are probably more common than tasks available for direct reinforcement learning, because as a rule rather than exception, in most cases in real life, we don't know the actual reward, right? So the objective of inverse reinforcement learning would be to find the reward as a first step, and then use this reward in order to find optimal policies. Now, in this work, the work that I present is a paper which is going to be published soon in RISC, and we also have a preprint version. That's the work that we did with our with my colleagues Jiayu Liu and Shao Zhang at Fidelity, where we applied these techniques in order to learn from actual fund managers by observing histories of their trades. Now, the key to this game is the choice of the reward function. And in this work, we've chosen very, very simple reward function, which has only 4 parameters, and all of them have pretty intuitive meaning. And this reward function is shown here. That's the only formula in my presentation. What it shows is the following. Vector X stands for dollar valued exposure of your portfolio, and we actually use here some dimension reduction. So vector X, we collapse all the exposures in this particular work into exposures to our industrial sectors. So we have vector X will have a dimension of 11 by the number of sectors. At the beginning of time interval t to t plus delta t, and u will be the changes in this position. So these are your trades. Now, the different terms in this formula have clear meaning. The first term, oh, by the way, all terms here are negative. So instead of maximizing reward, we can equivalently talk about minimizing the loss. right? Now, what the meaning of the terms in this expression is very simple. The first term is just the total trades in your portfolio. And the second term is the penalty for a mismatch between your portfolio and the next time step and some benchmark target portfolio. And which I call here P hat at time t plus 1. And finally, the last term, I'll momentarily get back to the second term. The last term is simply the convex term, which stands for transaction cost. So it's a simple model for transaction cost. Now, coming back to the second term, what it means, what it has in a target portfolio, as you see in the second formula, the target portfolio is a linear combination of some external benchmark portfolio, which I call here B, and the current portfolio, which is supposed to grow with some growth factor eta here. Now in total, this reward function has 4 parameters, and the meaning of these 4 parameters is pretty simple, right? So you try to capture this benchmark target portfolio, right? You also, by doing that, you try to minimize the total investment in your portfolio as represented by the first term, and of course, you want to minimize transaction costs. Now, reinforcement learning with this particular reward function, we did in our paper, we used a particular version of direct reinforcement learning algorithm called G-learning, which is actually a probabilistic extension of Q-learning. And details of the numerical algorithm that is used for this reinforcement learning can be found in our paper with Matthew Dixon. One thing which is worth noting here is that we don't use any neural nets. And the reason we can go without neural nets is because the reward function that we choose here is so simple. It's quadratic function of states and action. And this does the trick for us. So any other form of the reward which is non-quadratic would force us to use neural nets for this. All right, so what we do next in this work, we don't know parameters of this reward function, and this is where we use inverse reinforcement learning. And in doing that, we use a particular algorithm which is called T-Rex, which I really like. And T-Rex algorithm is, I'll talk about it in the next slide, but here I want to show just the pipeline of what we do. So we take the actual trading data, and we train it on pairs of stocks, actually using this T-Rex algorithm that I will talk about momentarily. And this allows us to learn the reward function for the reward, parameters of the reward function, which we then use in the direct reinforcement learning component. So this is the pipeline, and this is how we see the process of learning from humans and transferring it to algorithms, and maybe transfer it to other humans. Now, a little bit about details of this T-Rex algorithm. So it was published first in a paper by researchers from Washington University in 2019. And the idea was very neat. So you can maybe call it meta-learning if you wish, because it uses some additional information on top of your actual data. Basically, what it does, it scores whole trajectories which are observed and ranks them according to the final performance over the whole trajectory. Obviously, in finance, we have a good criteria for a performance over trading period. They're called Sharpe ratio, Sortino ratio, similar quantities. And this is actually what we use. So given a model for the reward function, which is the one that I showed before, we simply use the binary classifier for which gives a preference relation between whole trajectory according to the cumulative reward collected over these trajectories. And the nice thing, which is explained in the original paper, which really makes it different from other IRL algorithms, is that this T-Rex algorithm can not only mimic the demonstrator, which is what is done in most of IRL algorithms, but it actually can improve over the demonstrated behavior. And this is indeed what we find. So first, okay, here's the reference to the original paper, and here is the result of the training of IRL part. So what we see is, because we don't use neural nets, training is done in seconds rather than minutes or hours. And it shows like nice convergence in parameters that we infer. We train this model on different groups of funds that have either S&P 500 as a benchmark or Russell 2000 as a benchmark. And we get different, somewhat different values of inferred parameters, which we hope make some sense, as we explain in more detail in the paper. Now, this is for IRL part, right? So we infer parameters of the reward function, and then we, using this inferred reward function, we switch to the direct reinforcement learning step, and we try to see if we can first match the performance of actual portfolio managers and then improve over it. And indeed, we find that we can beat all of them. So we use small data sets in our sample. We found that we can beat all of PMs in our data sets, but we can beat them on average. And what is shown in these graphs is we show both the, so first on the y-axis, we show overperformance of our algorithm versus average performance of portfolio managers in our trained data set, both for test and trained data set. So we align the time axis. And basically what this representation means is that as long as you are in a positive domain, then it means that you do well, you overperform. And indeed, what we found is that at least as long as you don't look at too long time horizons, if you look for like a period of 3 months to 6 months, something like that, we overperform most of them. Again, not all of them, and our working paper has more details results on that. So as a short summary, the proposed framework, which combines inverse reinforcement learning and direct reinforcement learning, can work in this two-step setting. So we use IRL to infer the reward function, and then we use RL to further improve performance, either trading or asset allocation. And in this way, our method allows to essentially learn from collective intelligence of individual fund managers and outperform most of them. And this can be used for trade recommendation. So in this particular implementation, we focused on projecting our whole exposure onto exposure to sectors. And then when our model recommends increasing or decreasing exposure to a particular sector, we just translate it into recommendations on the particular stocks. It can be done in multiple ways. The simplest way would be just to, pick stocks with high momentum in a given sector, things like that. There are other potential applications. We can use this framework in order to analyze funds, for example. We can cluster funds according to inferred parameters of the reward function. And we can do other things as well. For example, we can choose a different way to do dimension reduction. For example, use factor-based dimension reduction and repeat the whole procedure. So this is part of ongoing research, and I would like to stop here and move to questions. Thank you.
Yep. Thank you very much, Igor, for this presentation. So I guess now we are in the second part of the roundtable, where we will actually have a roundtable discussion with the participants and with the panelists. So I would like to open with a question which addresses several of the talks here. So, if we look back on the last decade of research in machine learning in finance, uh, not surprisingly, a lot of the early research was developed in areas where there are lots of data, big data. And the two areas where there are a lot of data in finance are, on one hand, retail finance, for example, credit card fraud detection, one of the early applications, credit scoring for retail banking, and then on the other hand, high frequency applications whereby construction, there's a lot of data available because of the high frequency intraday data collection. So in these two areas, many techniques such as deep learning were deployed with some success because of the large data sizes. You could deploy very large models, and there was somehow enough data to train them on, and you got sensible results if you did it well. Now, here, the presentations I heard about today are somewhat about more challenging issues because several of you mentioned relatively small data sizes in asset allocation. At least in the talks I heard today, we're not talking about high frequency, we're talking about daily frequencies or even lower frequencies. And so there is some element of historical backtesting or learning from data. So my question is, how do we deal with this issue here? And is there not an issue of overfitting here in the applications you've been looking at? And how do you deal with that? So that's the first question, given the sizes of the models. So we saw, for example, very large models in Mikkel's talk. And the related question is, how do we validate such models? So is it these are research type of presentations you gave. You're all involved at some level with production. Does this go to production, or do you encounter issues with model validation? Do portfolio managers hesitate to deploy that because they can't control what happens out of sample? So I'd like to hear about that. So maybe we can go in the order. I don't know who wants to go first.
Well, maybe a couple of words on the language models. So certainly, language models. I think that we in principle have lots of data, but this is a little bit misleading in the sense that many articles are actually just the same stuff, right? Like when non-informative communications, right, and so on, right? So certainly when it comes to language models and also sentiment, you need lots of data, in the sense that models need to learn contexts, right? Different contexts, right? Because then you don't know. Obviously, the context in the future is very different from the context in the past.
Just to sharpen my question, so there's a lot of data for language models, obviously.
Right.
The whole web, there's text, but what you're describing is not just language models. You want to extract a financial signal from text. Yeah. So there you're gonna extract some signal from the language analysis, and then you need to assess somehow in the financial history whether that signal was significant or predictive. And there you're limited by the history of your financial data, so you can't go beyond that. So I guess there is a problem even if there's a lot of pure language data.
Sure, that's a limitation of finance, right? Overall, in the sense that we just don't have, right? Obviously, there's some people that thinks that this small data that we have in many contexts can partially so we can partially solve it building generative models, right? I'm not saying this is the solution, because the real solutions for small data is, right, it's a hard problem, right? Small data is in all contexts a really hard problem, because if you have a small set of small data points, then lots of functions could feed them, and you don't know how to choose there, right? And you just don't have enough, right? So there's my current thinking on this is the generative models can help a bit right? Trying to help us, right, build models for example, a bunch of stocks, right, like S&P 500 and so on. Like, we've seen recent papers on that. I'm not saying this is obviously their solution for not having big data, right? But it is certainly a new avenue, right? Or a relatively new avenue.
Okay. Igor, I'm keen to hear what you have to say about it. Like, in your case, you have data which is fairly small in size, I guess. So is that a limitation? You think it's hindering the production, or not really?
No, not at all. I don't see it as a limitation. I see it as a fact of life, right? And my solution is actually very simple. I don't use any neural nets altogether, right? So basically, and also, so I only have, as I mentioned, only 4 parameters. I have more than enough data to feed in these 4 parameters and test it out of sample. The other thing which it buys me is that I also don't have any issues with interpretability, right? So because the model is so simple, it's directly interpretable. It's causal, interpretable, and you have all the goodies. Of course, having said that, I should mention that my solution is in no sense a universal solution. Because I rely on this trick, I design my reward function to be quadratic function, and this is what makes the trick, right? So people who, and of course it's not a new thing, people who work in optimal control, they know this framework pretty well. So basically, it's just the probabilistic generalization of linear quadratic regulator. This is what we use. All right. But of course, if we step away from this, if we use a different reward function, then we will back to all these issues.
Yeah, I think so. So in your case, and also in Peter's case, you're not using neural nets. It's machine learning, but with a parsimonious parameterization. So I guess that's one of the reasons is you have this small data sets. Any comment from Daniel on this?
Yeah, I can add on what Miguel was saying, and also some of your questions, Rama. Okay, so the first thing is, when Miguel, you mentioned that when there is a new things like COVID, if we haven't seen it or heard about it, the model won't know about it. So it's all about spanning space, the space domain. So the data that we need to use has to span a large portion of the domain to be relevant and to be usable. When there is, so in the case, so there were several parts to your questions. If I relate it to news, because we trade on news, having information on a sentiment or something is not good enough, because as you said, it doesn't tell us if the probability of having a high yield afterwards will be small or large. So we need to assess that. And in order to assess that, we need to have, and then maybe I agree with you, Miguel, on the sense that we need to use generative models to produce some text which will have information about rare events, which will move the market, and then combine that with generated stock prices. We can use anything we want for the process, so we can have stochastic vol jumps and so on. Combining those things together and backtesting in a theoretical environments or synthetical environments, how the models will react before we put that into productions. So there is a lot of work in on the backtesting side, where we recreate data of a certain form with actions that you don't observe on a daily basis, or you will have to look at the last 10 years or the last 20 years and then analyze everything. So here we mix real data with these kinds of recreated data for training purposes and testing purposes.
Okay, well, thank you very much. So that brings me to the second part of my question. Maybe I didn't insist on it a lot. It's about model validation. So some of you have worked in banks. You know that the adoption of models in regulated institutions is a stringent procedure where there's a formal validation process. So here, one of the things which has hindered, in my opinion, the widespread adoption of some of these machine learning techniques, which do well in research context, is the lack of a clear validation procedure. And I would say in prediction models, it's maybe easier, especially if you have a high frequency prediction, because you will have data to test it on. But in some of the things that you describe here, like allocation decisions, you make decisions, but then the result may show up much further down the line. Maybe the allocation decision is made today, and the result is the target will be some long-term risk-return trade-off, medium-term risk-return trade-off. So you cannot afford to wait that long to see the reward, if we want to adopt the language used in Igor's talk. So how would you go about the validation issue here, and how have you dealt with that in the institutions you've worked with? What makes people adopt or not adopt or accept to validate a model like this?
I can share some remarks on that. So it's a very important question. It's obviously dependent on the problem at hand, or dependent on the methodology at hand. Part of it comes down to whether these are transparent models, in the sense that they are interpretable or not. The model that I spoke about here today, the JUMP model, is fully interpretable. I can analyze the model after the fact in the same way I can analyze a hidden Markov model. That gives some comfort to the modeling framework. The other part that tends to be done, and you alluded to this already, Rama, is that we already have a slew of models for different kinds of problems at hand. More traditional models of finance that we can look at and use as benchmarks. So if we're dealing with a less transparent model, a very non-transparent model, one thing that we can certainly do is to compare it relative to a suite of benchmarks. Forecasting models, as you spoke about, are easier to validate from that perspective. But similarly, for portfolio construction, well, none of us know what is the most optimal way of building portfolios. That depends on risk aversion. That depends on a number of different assumptions. But at a minimum, we can compare to more traditional frameworks and see if over longer periods of time we are able to extract better performance on the upside as well as on the downside.
Well, in the end, we all have a problem, right? Finance is a very empirical science, and we have no way to guarantee that the future is going to be like the training set, the future is going to be like the test set, right? This is always going to be a limitation, because you can never ensure that what you can see in the test set is what you'll have in the real life, right? And we all have to be aware of that, right? But that's many reinforcement learning problems are actually encountering this problem, right? When you're outside the lab, then the idealized conditions that in which you have trained your agents are no longer maybe that stable, right? So real life problems have this non-stationarity, if you want to say it, in which and that's why the model validation and risk management is so hard, because reference is not clear, which is how can you characterize a model is good? It's because 1 year is when last 6 months test performance have been good. We all know that this is not enough, right? But the problem, we don't have the ground truth out there, right? To say, so that's why we explore robustness, to see if this model actually would have done a good job in different market environments. And again, that's why we have model validation teams that try to say this is a good model, right? In regards to the algorithms you've used and the test set and the training set.
Okay. Can I add one thing, Roman, on that? Well, we don't do validations on real data because it's very limited, as you just explained before. So in our case, we did two things, which is pricing options using reinforcement learnings and allocating portfolios on the real data on market. So we need to be in a position where we need to kind of simulate in a lab real market data over different types of scenarios which are more or less stressed with high volatility, high jumps, and all of that, generate hundreds of thousands of trajectories, and then test the models both on the pricing side and on the portfolio allocations. Once we're happy that the model can recover a very large numbers of existing models, and then it gives the same results as whatever you would be doing using Monte Carlo simulations, PDs, or anything else, then we are more confident into what we're doing, and hence the distributions of Sharpe ratio or of Sortino or these types of things. There is no one way, but then there is a distributions of what you can get based on whatever scenarios you're going to put in place. So this gives us the confidence of that the model is robust enough, and then after we paper trade. In fact, in real data, you paper trade, and then you see how it behaves afterwards under that before you really go into production.
Okay, very good. So I think the last question I have is so if we compare what you presented today, all of you, with what we have in, let's say, big data areas of finance, which I alluded to in the beginning, there you can afford to do pure data-driven modeling. Here, what I see is a mixture, what people would call hybrid AI, but I mean, just a mixture of lots of quantitative modeling, actually, with some automation and some degree of learning from the data. Would you say that this is? Would you say that this is the nature of asset management problems that imposes that, or is that a constraint, or what's your take on this?
Yeah, let me use a Robert Lederman some sort of framework, right? So Robert Lederman, for example, says that climate change, right, it's one of the most important problems, right, for humanity at this very moment, right? We don't have big data for that, right? So we don't know what's going to be, we don't know what's the impact of 1.5 degrees on different environments and systems, right? Or at least we don't have that historical data, right? So this hybrid approach in which you obviously use data to build models, but the fact that you build parametric models, right, based on principles like physicists and so on, right, are part of the what it can be called forward modeling, right? Because you can just look backwards because you just don't have data sets for that, right? And you have to look forward, and then you have to use domain expertise and some sort of more traditional mathematical physicist kind of modeling, right? In which you have to build the impact of the weather in the, in the sea levels and all that kind of stuff, right? No, again, you don't have, in many situations, just big data is a myth, right? You just don't have the luxury of having enough data to say something really very definitive about the problem, at least in the biggest problems we have on the table.
Okay. Any other comments on this?
So in the big data case, we often say, well, we can lean on the data and we extract, as you said, all the features directly from the data. The less data, the less observation that we have often puts us in a situation where we as researchers have to have a prior view on what the world looks like, and we need to lean on that prior, right? This can be expressed, of course, in the language of Bayesian statistics, or also in modern machine learning in terms of regularization. Another way of approaching this, right, even if we are not Bayesian at heart and adapt the Bayesian framework, whenever we subscribe to a certain set of models with a certain set of parameters, we are imposing a sense of inductive bias on the view of the world, right? We are making certain assumptions, certain stylized assumptions of the specific features that we want our model to describe, and we limit those sets of features to the essentials that we have an ability to calibrate to the data, or the limited data that we have at hand.
So I think data scientists actually have to be much more brave, right, in terms of enriching the data sets, right? Because we know that the data sets are very limited, because it's just historical, and we learned by crashing the car that historical is not telling a lot about the future, at least in finance, right? Hasn't told us a lot, because we've had the tech bubble in 2000, we've had the financial crisis, we have now this another tech crisis, and we had the pandemic, nobody had the crystal ball to say this is coming, guys, right? So but we have to be more or braver, right, with the generation of of the excess, so to speak, knowing that this maybe we can create more plausible, right, excess, so to speak, like the guys in images are doing, right, with diffusion models. And how do we know these things work? Because we look at them and these models seem to be produce human-like pictures that are interpretable, right, and they make sense, right? But how do you do that in finance terms is not easy, right? But there's a lot of I think work we need to do, I think.
Okay. Well, thank you, Mikel and Peter. So I guess we're nearing the end of the round table. I would just like to conclude with a short conclusion. So I mean, I get asked often by people, "Oh, don't you think that quants will be replaced in a few years by machines and algos?" And I think what we heard today is quite interesting, because what contrary to the early research we saw on machine learning in finance, where people were basically downloading packages in Python and TensorFlow and running it on data and saying, here's a classification for FX prediction or whatever. That's not what we saw today. I think what we saw was a careful blend of models, analytical models, machine learning techniques, advanced concepts from statistics and optimization, tailored to a specific application in finance. None of the things that you showed were generic solutions that apply to any data set. They're not applicable to rainfall prediction or optimization of livestock, but they were really tailored to finance, which shows that the field has matured, and you've been doing a lot of work blending your domain knowledge in finance with quantitative modeling of the previous decades and the advanced machine learning techniques. So I think we saw 4 nice examples of how quants experience in modeling and their experience with data actually is very useful for deploying machine learning techniques and AI in finance. And I think we're not going to see quants being replaced in this role anytime soon. So on this note, I will close this roundtable and maybe hand over to Balázs if he wants to say a closing word.